Good morning, everybody. It is still morning here in Playa del Rey, California. I know it's noon there on the East Coast, and Dr. K, you're in London, and you're running, what, about 5 p.m. right now? Is that
Yeah,
correct?
days are getting noticeably shorter.
Yeah, same here. We even had a little bit of rain here down along the beach, but it's a nice change of pace. Anyways, the market's got its own change of pace going on because you can see on the NASDAQ chart right here that we've come off. I guess we're working. I'm going to count 4 sell-off days. I'm going to count Friday's action, higher volume reversal as a sell-off day. So you come down 4 days as of yesterday, and you notice that you came down right into the lows of the handle area here, right around the 30.57 level here, and you found support there yesterday, and so you get a little bit of bounce, and you can figure in this market, you start coming down a few days, and things look real ugly, you can pretty much count on some sort of bounce, because we all know that with a little faith, a little trust, of course, in the Fed, and a little bit of the Fed's magic QE pixie dust. Anyways, throw a little sound effects in there, but you get the idea. And so this morning the market gaps up. I wasn't surprised by that at all. And this morning I'm going to give you guys a little bit of insight as to how we're handling the market currently by showing you. I got my main screen up here, and I should point out this is pretty much what I use. One screen. I don't use 10 monitors. When I left O'Neill in 2005, in late 2005, and I started running hedge funds, I was enamored with the idea of having 5 to 10 monitors. I think I had essentially altogether about 6 monitors in my office at one time back in, say, 2007, 2008. But there's just too much coming at you. And one thing I noticed when I was working for Bill O'Neill, and it struck me very hard, is that he used to watch a screen with about 20 quotes on there, with about 20 symbols and the major market indexes, and they were in big type, about, I'm going to say, a ½ inch to 3/4 of an inch high. To me, they looked like they were 2 feet high, because I run pretty small type, as you can see here, and a fair number of symbols. Now, if you saw Dr. K's screen, not too different, but I'm going to say smaller type Dr. K and a lot more quote boxes. Is that correct?
I actually try to keep everything on one screen, and but I do have generally the smaller. I have your smaller type. I don't have the bigger type on there, and so in a good market environment, the screen will be completely filled, and
Yeah.
that's kind of my gauge of how strong an environment we're in, and my screen has not been filled all year, so it's got the leaders and it's got some of the ETFs and whatnot, but it's an indication that actually the last 2 years have been quite weak for going long in the markets.
Yeah, and you don't really need to see that much going on. Sometimes too much will scare you one way or the other, and we basically use our analytical systems, namely Wanda and eSignal, and alerts. Basically, we set alerts for the stocks we're keeping an eye on, so we don't have to sit there with our faces in the screen. And I basically use a 2-monitor setup. I got the quotes on the right, on the left side, whatever I want to work on. And so, we find that this is the most efficient way, and I've actually come full circle. And this is a topic we talk about in the book that will be published now. They're saying in January. Now, we can tell you all who've been asking that we just finished all of the final proof changes on the book, and we're happy to say that this is actually, I believe, somebody correct me if I'm wrong, but this actually is the first investment book I've ever seen or heard of that is printed in full color, right? I mean, Dr. K, do you know of anyone besides what we're coming out with in January?
It quite possibly could be the first, but we should get confirmation from Wiley on that. I mean, it is new technology that they're rolling out, so we may be the first.
Yeah, but it's gonna look either way. It's gonna look really nice, and I think it's very useful that way because it will. The intent of the book is to put you through your paces in terms of exercises and whatnot. But anyway, so you can see my screen today, and I'll give you some insight into what I've been doing over the past few days so far this week. I can tell you that I've been on the short side primarily, and I go, as most of you know, what I'll do is go after 3 or 4 short sale targets, and I go in very heavy. Intraday, I may go in up to 100% position in each, 400% total, using all of my day trading buying power, looking to get a reversal. And so I come in this morning, looking at the NASDAQ yesterday, I did feel that you were primed for a bounce and that we would see it, because the QE ferry is out there, and this is actually what the QE ferry looks like. And I would like to thank our good friend Dave Eccles for sending us this photo that he was able to take on a strange purple lit night where he was able to catch a silhouette and take a photo of a silhouette of the QE ferry. And you notice there's her pixie dust. It may be a him. I don't know. I'm not sure what Fed Chief Bernanke is into after hours. You never know. But you can see the pixie dust. Unfortunately, what I've heard is that a couple of the pixie dust refineries have recently gone offline due to some small explosions caused by an excess of Mexican food in the lunchrooms there, I believe. But in any case, it appears that you're probably getting a little bit of a shortage of pixie dust right now because you're not getting a lot of pump in the market this morning. And so I'm not sure whether you'll see it come on again later on. But basically what you have is the bounce off support. I figured you could rally up to the 50-day, 3087 on the NASDAQ composite. You're not even able to get there. You're kind of losing some ground. But that doesn't necessarily mean that you're going to blow apart. But if you look at my screen here, some of the stocks that I've been coming after, I should also point out, I'm going to get rid of this. Let me just say that I might look for an undercut of these lows that could set up a rally. Otherwise, the next stop is going to be down here at the top of this range, probably, which may meet up with the 200-day moving average. And that's a possibility. So the market hasn't had a real good correction in a while, so it's a possibility, I think. And you're basically in a news-free zone or a catalyst-free zone right now going into the election in early November. Now, today we have the vice presidential debate, and next week we have the presidential debate. And I guess there will be some movement in the polls as a result of the debates as there was last time. I'm assuming some of that. It may be that Romney takes more of a lead, and we have to. I was on a radio show yesterday. I think it actually appeared this morning. We taped it yesterday. And they asked me, what do you think the election is going to do for the market or not? And I would say that you can't really get into trying to project outcomes based on a particular outcome of the election, because you may see if Romney wins, he has said, as we've discussed previously, that he would remove Bernanke. But, of course, his term does not end until 2014. And that means that he's at least there for another year or so, and it's not clear when the market may begin to discount the potential and or say disruption of QE, Fed QE policy, money printing at its essence. But in any case, the markets may look at that negatively if Romney wins. On the other hand, how much of that is made up for by the economy picking up, assuming he can put through policies that do actually spark some growth. So there is going to be some counterbalancing there. I think the market, you just have to watch the market. And a lot of people have come to us, well, what do you think about the election? How's it going to affect the market? What do you think if Israel attacks Iran? It's like, okay, what do you think if Israel attacks Iran?
Well, when those sorts of things occur, if the market sells off, that's usually a buying opportunity, because those sorts of crisis situations are very short-lived.
Right. Now, would you try and anticipate that? Is there any action you could take to position your portfolio for such potentiality?
Yeah, if there were, I would have indoctrinated it, but I've never seen any such thing, and I don't know of anyone who can do that.
So, yeah, so there you go. You see, you just got to watch the market. All we know for now is we're in a 4-day sell-off, taking you through the 50-day on the NASDAQ composite. If you undercut this level, that could set up an undercut and rally, or you could be heading for the 200-day. You don't know, but you do have to keep an eye on your stocks, and you do have to keep an eye on your stops with respect to those stocks, and I think that's really the key. Meanwhile, the S&P 500 looks a little better, trying to find some support at its 50-day moving average and the lows of late September, which, this is all kind of normal action. What's S&P off, like 2% off its peak, while the NASDAQ is about 4% off?
That's about right, yeah. Exactly.
So you're kind of in, the cusp of short-term correction land, and that's pretty much where we are. IBD said you're in a market correction. I would say, yeah, you're in a market correction. I think that's true because you've seen a number of stocks come off and break down. So let's just clean up my screen here. The less, the merrier, as I like to say. And let's just look at a couple of things that have happened. Of course, on Monday, you had Apple violate the 50-day moving average. It closed below the 50-day moving average here. That's the blue line, followed by a break below. Now, I started shorting Apple in here on 661 because it was finding resistance at the 10-day. And sometimes off the peak, when you see this little mini head and shoulders, I would say also that's barely discernible on a weekly chart. Let's pull up a weekly chart on Apple. You know, you might say, here's your little left shoulder, here's your little head, and now your little 1 week right shoulder, now you're breaking down. And so on that basis, I thought it was a tactical short. And when the market starts coming off the peak and you start to see some leaders waver off the peak or break down off their peaks, if I can put together a rationale and some rules for shorting them, I will. And in fact, if you look at Apple, what I think is interesting here is we can use Livermore's century mark rule in reverse. And I think we've talked about this over the last couple of weeks a couple of times. And I know a couple of people who have shorted the stock right off the 700 level, because you notice down here there's not very much volume. Let's spread this out just a bit. You can see down here very little volume as the stock was trying to get up into this 700 level. So really demand is waning, and of course the thing breaks, and once it fails at the 700 level here on the gap, you could short it using the 700 level as a quick stop, and that's generally within a couple 3%, even though you know it's a lot of points, but just think of it in percentages. Now, notice today you have Apple breaking down again, and all it was able to do is get to the 65-day exponential moving average. That's the black line, but that's also the peak of Monday's high on the intraday range. So, you know, I shorted off here. You get about 30-something points, I guess, about 5%. But we covered right here, pretty much at the lows. Yesterday, Dr. K and I were talking just as Apple came down below 625, and I said to him, "How's this looking as a low for Apple here? Where do you think that'll come in?" He said, "Well, right here." And I said, "Yeah, I think you're right." And so we just covered it, and the thing has bounced since then. And that's a natural bounce because it is occurring off the top of the prior base. So we can see the base prior breakout here. So it's right on top of that now. So, you know, I view this as a tactical short, and I'll go ahead and hit these because the rationale is that you failed at the 700 level, and then you're failing here at the 10-day line. And usually very quickly off the peak, you'll see the 10-day drop below the 20-day, and the thing will come off, and you can run it very tight with a stop right there at the 10-day line. So you can see they're applying a little more pixie dust here. The Dow is up 0.26%. NASDAQ doing a little bit better. Well, not right now. It was earlier, but it's coming, I think, with Apple breaking down. But Apple may test that 624.25 level again. For my money, I'm going to go after some of the weaker stocks. And you'll notice I have Amazon up here. What I'm looking at is another quick, possibly a tactical short down into this level here, down into, say, 235 from here on a 50-day moving average violation failure. Generally, those will come lower, and so you can try and peel off the short there and pick up a quick few points on that. And like Jesse Livermore, I'll play for points, and so that's what I'm doing here. I'm short up higher in the range today when it opened up right at the 50-day, and so it's coming in pretty good right now, so that's not too bad. Baidu was another one. We sent that out yesterday on a report that you could short it, looking at it as a shortable gap down type move. Big volume, 92% above average, comes off, breaks down. The other thing about this is if you squint real hard, maybe you see a left shoulder and a head and some right shoulders. But to me, that's neither here nor there. I think that when you're looking at shorts, some of the better ones that are working right now, and you can see that in a broader perspective, this is this big topping type formation. You can see a bunch of head and shoulders in here. It just looks like this domey thing that maybe tells you this is the end of the line for Priceline, which has been a fantastic stock off the 2009 lows. It's had a huge run. So, you know, this could be a top, and it could be coming down, and it could come down a ways. And the fact that it's so weak on a day like today, when the market gaps up so strongly on the QE pixie dust maneuver, it tells you that something is not quite right with Priceline and Baidu when they kind of give it up. Look at this, because you have the reversal here. So we put this out this morning. My alerts got hit. 110.95 on Baidu. We talked about Priceline before being shortable as it rallies up in 640. I think we talked about that last week, and I, in fact, did put the short out up there. We're still working it. I think you're heading to one of these lows before you get any kind of real bounce, and that might take you into the 50-day, but that already happened this morning. I was surprised to find my alerts hit almost right at the opening, and so I was actually putting shorts out, and I'll do that. If I'll set alerts on the upside where I think my short sale targets should rally to, and if they go off, I will put a position out right there, and I got to stop, 1 or 2%. If I get stopped out, I'm gone, and I'll wait and see if it sets up again. But I'm sort of surprised this morning that I put out Baidu as soon as that alert went out, and it's coming in, and it looks weak to me. Looks like it's headed lower, and I'd say probably this low at 100 is maybe your first stop, so 10% from here. You know, it might be tactical, it might be something more, but you can come in every day and work these positions heavy the way I do, or at least I can come in and do that every day because that is what I do. Intuitive Surgical, I'll put a alert at 498, and that got picked off this morning, so I put out a position here. It's sort of wavering here, and we'll see what happens. Price line 610. Just underneath the 50-day moving average, and sure enough, it hits it and it rolls over. So I think it's interesting that some of these stocks, there are weak stocks, and so there are targets to go after on the short side. But you have to view it very cautiously, and I think you have to be very nimble, and you have to set tight stops, and most of all, you have to be willing to cover quickly and then come back and attack again if things set up further up in their patterns, and you really don't know where or if they're going to roll over. For all I know, the market's bottomed. Yesterday was a low, and now you're going to see a rally, and we're going to go higher on QE pixie dust. And maybe that's what happens. But for now, all I know is I've got some shorts that they are working. Another one I'm working here is Bed Bath & Beyond, and to me, you have two huge gap downs in the pattern, and this is an inverted flag, a bear flag, or another. What I consider a more descriptive term is a ledge, because it's fallen once, it's on a ledge on the side of a cliff, and it's ready to roll off the ledge and go lower. This looks weak to me. So the rally up towards the 10-day moving average, right around 62.13, a little higher. You know, it can go 1% higher. It did that the other day. Looking for a breakout to the downside. This looks weak. So they don't have to work, and I have to tell you that my expectation is that they won't work, and I'm going to get stopped out. So, you know, if I'm making some money, I'm going to be pleasantly surprised from a psychological point of view, and just work it that way. So, but, you know, steady and quick, it's pretty much how I want to be. I want to be putting these out and then try to give them some time to work. If they don't work, just run away and come back. So that's basically the short side of this market. Dr. K, do you see anything on the long side that's getting you excited right now?
No. I've got my list of leaders, but they're they're stammering. So it's a matter of which way they go from here. They pulled in with the rest of the market. That's nothing unusual, and it seems like there are a lot of names. More names are at pivot tipping points in terms of if they fall lower from here, then there's something seriously wrong, and that also is indicative of the general markets. If they continue lower from here on an accelerated volume, then this correction might be steeper than we think. So just a question of monitoring these positions, but nothing to get excited on the long side right now.
And you do concur with some of these targets that we've been going after on the short side?
Yeah, that's all good. All those stocks look quite ill, and it's nice to be able to capture some quick points, especially on a gap up. A minor little mini gap that these 6 stocks will sometimes have, along with a market that opens 0.5% higher. So that it's almost like easy pickings, but of course on a very short-term basis.
Yeah, and we'll see how this develops. So we don't know what's going to happen, and even though we have our inklings of how we can put it together from an intellectual point of view. The bottom line is you stick to your rules. And I'd also point out that with the market direction model, it operates on a set of rules. And I know that we'll get a couple of emails, we really don't get very many, where people will ask, well, why didn't we take profits, and why are we sitting here? Well, the MDM, market direction model, or the MDM, I'll call it for short, it operates the way it operates. And you have to understand how it works. We know that it has been getting whipped out on signals because the market moves just enough in one direction to trigger a signal before moving the other way. On the last buy signal actually moved up higher, but again, the model is not intended to capture short-term moves. It's not intended to capture wiggles. If the market runs up 3 or 4%, 5% from where a buy signal occurred, it does not mean that you won't get stopped out at even a tiny loss, or a small loss, hopefully not a big loss. That could only occur on a major gap down. And in this market, who knows what could happen on any given day. But it operates the way it does, and we can't start gaming it in terms of saying, oh, we're up 4%, let's take profits, and that's not really how it's intended to work. However, you yourself can engage in that sort of thing, and I have to admit that I do trade some of the 3x and 2x index ETFs on that basis, on a short-term basis, because I think some of the signals are pretty clear. So, and there are a lot of intraday systems you can use for picking off buy signals. I know I've seen a couple of guys talking about these short-term systems. For example, you could just use on a 5-minute chart. You could use a MACD, and I'll just show you how something like this might work. And what you do is you go and find a couple of things that maybe guide you, and you can see you have the gap up this morning in Baidu, so I view that as shortable when my alert went off. And then as it breaks down, I use this six-period exponential. So since it's a 5-minute chart, the 6-period chart, this is basically 30 minutes, this moving average here, and then it's a 20-period, which is an hour. And you can just use this to guide your trades in and out intraday, and I'll trade some of the ETFs are allowed to guide my concentration in the short term on this. But I just want to point out that this is what I'm using today. It might change tomorrow, and I vary with it depending on how the market is acting. But what I have noticed is that in this environment, because there are very few sustained trends, we find that oscillating type of systems seem to work better here. And of course, what we found with the market direction model, which is not an oscillating system, it's a trend following system, that it oscillates, the market oscillates just enough to trigger the signal. So flipping that around in the short term, we can apply some of these intraday models to guide us and keep us from getting into too much trouble. And so what I'm saying is you could devise a system yourself whereby you trade the ETFs and do take profits on your own. But know that if the trend continues and the market just goes higher without you, we can't tell you where to re-enter. So the market direction model is what it is. You have to understand it on that basis. Anyways, let's talk about a couple more things before we go to some questions. Silver, for my money, I think, and I'll let Dr. K chime in after me, but my view is on my silver gold positions, they're gone. And my view is it couldn't get through this range, and I'd lost them a few days ago. And it's possible to sit here and hold a position bought lower because we did have some great pocket pivot buy points. But my view here is it's looking a little toppy, and what I can afford to do, given the gains from here to here, is just back off or even go with a smaller position, hang out, and see if it's able to hold, because it may just go sideways while the 50-day catches up. But you notice right now if you break, the only discernible point of support would be the lows here at around 32.40 on the SLV, or you're looking at the 50-day, which is down at 30.85. Same thing goes for the GLD. And you notice it's kind of stalling out here underneath the 10-day. But you're dropping either here or testing this low. And it could just go sideways and then break out. But I think what I like about the precious metals when I'm playing them is I like the strong thrust that they can often have in their upside moves, and that's really the meat of the move that I want to get on and ride. And I'm not necessarily willing to sit with things too long once they've had what I think is their move. And in this market, I think you've seen a lot of stocks, and also the commodities will run up 10, 15%, 20% maybe, and then they back off. So you're not going to get hurt bagging some profits once you have a position where you're up 15 to 20%. So my approach is basically centered around taking more short-term profits, and that will work the same way for the short side. So anyways, Dr. K, what's your feeling on the precious metals right now?
Well, they're going after a big move. They're consolidating their gains, and quantitative easing is in effect on both sides of the pond. So I think the overall trend is going to be higher. In the meantime, these GLD and SLV may continue sideways, and SLV, keep in mind, tends to be 2 to 4 times as volatile as GLD. So I would just keep an eye on GLD. That's the bellwether here. And as long as it continues sideways, if you have a position, you could sit through this move, this sideways move, and then add to your position as it emerges out of this consolidation.
Yeah, and my approach is not too much different, although I elect to not hold any position while I wait for it to move, since I'm always looking to deploy my capital most efficiently at all times. So given the high-octane way that I will run my own account, just so you all know that, and that's based on one's own psychology and the way one likes to operate. But we basically see it the same way. It could just go sideways here, and I think you can, if you have a position and you're comfortable with your profit cushion, you can sit until further notice. If you see more breakdown and more decisive selling action or sell signals in the metals, then you act on that basis. But you could sit and go sideways if you like to do that. But you know, I like to go after the juice wherever I can find it. And so today I'm having some fun with Priceline on the shorts. I actually have been having fun with it over the last several days, and it's working. And hitting Baidu here, we'll see if that pans out. So far it is. And if you had to be short the stock, looking at the chart right now, today's a good day to be short. We'll see how it pans out. I mean, I'm not really placing a lot of high expectations on any of this because, as Dr. K says, the QE fairy is still flying around out there, so you got to be really careful. You know, it can pop at any time, and I can tell you that I would not be surprised, even with the Dow and the SP and the Nasdaq kind of fizzling out intraday. We can look at their intraday patterns here, and you can see there's the peaks this morning. It's just been a slow ride to the downside. I still would not be surprised later in the day to see some kind of jack with some QE coming in. So it wouldn't surprise me. So let me just say that. All right, let's go to the questions that we love to answer, and we always get a lot of great questions. Is SLW a possible pocket pick? Pocket pivot, I'm assuming that's what you mean. And let's take a look at that. Dr. K, your comments there. Let me find, where did my chart go? I'm going to get rid of, well, no, we like that. Let's see. SLW had a pocket pivot back here on this day, but that hasn't really held. So what's your take there, Dr. K?
Well, it's moving sideways, similar to SLV. And if you look at the overall chart of SLW, it tends to trace SLV fairly closely. So, again, I would use GLD as your beacon, and as long as that doesn't break down, I think you can sit through these sorts of names like SLV and SLW since they correlate to a fair amount. SLW, just always also know what your volatility is in the instrument you're dealing with, and like I said, SLV is 2 to 4 times as volatile as GLD, and so you should also have a look at SLW and see what that level of volatility is relative to SLV. It's perhaps a little bit more volatile, being that it's not an ETF, but is a mining company.
Yeah, they're basically a silver dealer, so I think they're leveraged pretty well at the price of silver. It looks that way because it certainly tracks with the price of silver, and with it looks like a fair bit more juice. I think you're right there, Dr. K. So that's what we think of SLW. Now, someone's asking, what would a price target be on Baidu? My price target on an intermediate term would be this low over here. So that is from July 17th. The low there is 99.71. So you're looking at 100, and so I'm looking for a 10, 11% to the downside, maybe more. But I think also long term, I do think that Baidu could go a lot lower. So what I'll be doing is if let's here's the weekly pattern. Oh, that's really ugly looking. Let's see. You can see this looks pretty ugly, and to me it looks like it wants to break out to the downside. And I think you could get to that low, and you might have a rally at that point. So, depending on how I want to handle the position, I'm pretty heavy right now. So it's about 100% position right now, and I've got a couple of percent in it. So I feel comfortable to the extent that one can be comfortable when they're running a 100% position. But in any case, the way I look at it is it might head for this low, fiddle around, and then work lower. But it ultimately might get a big bounce at this low, and so I might cut my position back to whatever it is. Overnight it might go to 30 or 50, or it might go to 0. A lot of times what I'll do is I'll short and then cover at the end of the day and look to re-short again the next day. And I should point out, for accounting purposes, I adopt the trader designation for my trading account, so I basically mark to market, and it allows me to take all of my short-term losses would otherwise be wash sales on the short side. So, but you do have to demonstrate that you trade actively. So 1,000, 2,000 trades a year. I actually easily get well over that, and so that's how you can do that. I think that's how it works. But I don't know yet. I'm trying to give tax advice, and the bottom line is that I'm talking out my Yahoo here. So you consult with your tax professional. But that's how I deal with the wash sales. People ask about that. SLV seems weaker than gold, as SLV living below the 20-day moving average. Remember, as Dr. K said, silver is 2 to 3 times more volatile than gold. So we would expect on any given pullback in gold that silver would pull back more. So it could drag it down further below, at say, 20-day moving average. Now, we've seen in the past a 20-day moving average for silver, SLV, for the ETF has been support on prior runs. We can look here and we see that back in 2010, in late 2010, the 20-day was pretty good support for, that's the green line here, for the SLV. And the same thing was the case on that last run. It had one pullback here, but it also never violated the 10-day moving average, because right here, if you can see that, right here on this day, even though it closed below the 10-day moving average, the magenta line, it never moved below the intraday low of that low. And so it never violated the 10-day either. So in that case, both the 10-day and the 20-day were followed on a strict basis. The 20-day more so, because it never really broke below there, closed below. But I don't know if you can necessarily assume that it's going to hold the 20-day. It bounced once off it. It hasn't held it. And so you can't really assume that this is meaningful. And that's why I'm saying you could pull back, and it may take some time. Maybe the 50-day catches up. So that's a possibility to be looking at. But you can't expect that the GLD will probably be weaker on any pullback, because it is 2 to 3 times more volatile. Right, Dr. K?
That's about right.
Would like your thoughts on Workday's upcoming IPO. I don't have any thoughts on IPOs. They have to trade for a few weeks and set up in a base before I want to touch them. Dr. K, your thoughts?
Yeah, I mean, it's roulette. If you're going to buy an IPO on the first day of trade or the first few days, you got to wait for the pattern to trace out, and then at least you can then assign potential pocket pivots to the pattern. But until then, it's just it's too much risk. I mean, you're really dealing with a 50-50 situation, and you always want to have the odds in your favor.
Yeah, so we don't have any thoughts on it, and there really are no thoughts to have other than just waiting for the thing to come public and then watching to see what it does, and if it sets up in a base, and you watch for pocket pivots, because you can get pocket pivots before it even sets up in a base if it has a short consolidation and then issues a pocket pivot there, and we've seen other stocks do that, I think. Somebody asked me, what do you use your second monitor for? What do you put watch on that? Girly pictures. No, actually, what I'm running are my other analytics programs like Wanda, and which is William O'Neill Direct Access. It's the institutional product, which I guess is like Marcus Smith on steroids. And so we have that. I have that going. I have my web browser, and I keep briefing.com up for news. And I think Yahoo Finance for news also works pretty well. And I should let you guys know, I've talked about having a Bloomberg, but I actually had that shut down because I was finding it's not that useful. Yeah, there's a lot of great news, and I think they do have more current sponsorship data for stocks, but you know what? I could not discern an advantage, a real material trading advantage, from using it. And what I actually found is shutting it down a month or so ago, I'm doing better without it. So again, we get back to this whole thing of the less noise, the better. And I might point out real quickly, you'll notice on my screen, the market's up, but even when it's down, it pretty much looks the same. Because when my stocks trade, for those of you who use eSignal or any other system that lights up in the background, you notice these light up this blue color, different shades of blue and green whenever they change. Some people will color code them so that they light up red when everything's moving down, and I think that can influence you in negative ways, and really all you need to do is discern what the price action is doing, not what color it is, because really color is irrelevant. It's just something we do there to get to alarm us, I think. It's like yelling fire in a theater, and I think that's what happens sometimes. I've seen some quote screens, when the market's ugly, man, oh, it makes you want to run out of the room. It's so red. And what I use are very cool colors to keep me calm, because I am normally a very hyper person, much like my good friend Dr. K. So, I just use it as my other working screen, to do stuff on, to answer emails, to write love letters to my wife, stuff like that. Anyway, let's scroll down here. 5 distribution days and MDM still on the buy. How close to moving to cash sell, Dr. K?
Well, like I said earlier, we've got at somewhat of a tipping point here. I mean, if we're going to continue to accelerate to the downside, the model's not going to stay on a buy signal. Unfortunately, if that were to occur, we're doing a round trip here. But as I said in this morning's pre-market pulse, that the model is not designed to catch small little blips and changes in the averages. It's designed to catch the major trends, and therefore it will sit through minor corrections, and this would be a minor correction with the Nasdaq off 4% and the S&P off 2%. So it's still gonna, it's still in its buy signal, but we are getting closer to a change in signal, to either a cash signal or a sell signal the further off the market comes. And of course that has to be supported by continuation of falling leadership.
Yeah, so we joke around that I'll know when to cover my shorts when the market direction model goes to a buy signal. So that's a possibility too, right? Would you say so, Dr. K, or has any of that been accounted for in your model?
Well, we got that from May to July, actually May to early August. The market was in a perfect wide banding movement pattern, so we haven't seen that happen in the Nasdaq before, and that was causing problems for the model. Now that could very well happen again, although I have addressed for it in the model without changing anything fundamental. So in other words, right now, the model is closer and closer to a sell signal, but it is taking into account that we could get a whipsaw situation, and therefore it may just very well sit in its buy signal. And that would have to be supported by slowing volume on days when the market is lower, and we'd also have to see some sort of consolidation in the leading stocks to support the idea that the model would continue to stay on its buy signal right now.
Yeah, and the fact that Investors Business Daily says market in correction, that's just a label, and it tells you the market's in correction. We know the market's in correction because it's 4% off its peak on the Nasdaq and a couple of percent off on the S&P 500. But that doesn't really tell you anything in terms of a straight-out sell signal, and so the market direction model is not going to correlate to that because it's not intended really in the same spirit. Is that correct, Dr. K?
Well, in terms of examining IBD and its track record, when it goes to market in correction, that is constituted as a sell signal, and it's to IBD's advantage that would be labeled as such, because over the years since we started tracking them, I think this was December 1994, IBD has had an exemplary track record compared to the vast majority of timing sites out there. And that said, I mean, there is a big difference in performance between what market direction model has done since then versus IBD. Nothing against IBD, but the MDM model has using the Nasdaq Composite as the benchmark has completely outperformed it. But all that being said, and by the way, the last 2 years IBD has had obviously a lot of trouble in terms of gauging the markets because they've been sideways and trendless and volatile. So most of these models have had their fair share of difficulty in this trendless environment we've been in. Obviously, 2011, the model was able to come out with I think it was an 11% gain on the Nasdaq Composite and a 35% gain using the 3X ETF TECL, even though the Nasdaq was down in 2011. 2012. Definitely the most challenging year I've ever seen, and it also constitutes the largest drawdown the model has had. The model prior to this year had its largest drawdown in 1999. That was a 15.7% drawdown. This year, well, if you take the peak to trough of the last many months, the model's worst drawdown is now 18.2%, and that's using the Nasdaq Composite once again as the benchmark. So again, that's all to say that these are very unusual times we're in. Knowing market history as I do, I'm not losing any sleep over this because these periods do come to an end and markets will trend again, and the model should be I'm not going to change anything fundamental to the model simply because markets will get back on track. And of course, if this time is different and they don't, well then you might as well throw a dartboard at the newspaper and forget about investing altogether in terms of being able to predict anything. And I don't think that's going to happen. It never has.
Never say never. All right, let's go to some other questions. Are pocket pivots actionable during this correction? I would say probably not, but they could be, but you have to use a stop. You know, any trade is possible in any environment as long as you have an out point. But in general, I would say that pocket pivots, we tend to pay less attention to them or give them less emphasis when we think the market is in a phase where it's either going to consolidate or pull off a little more or just be funky in general. Is that correct, Dr. K?
Yeah, I mean, there might be the occasional rare, I'd say the rare pocket pivot that is actionable when the market is in a correction, but the stock has to really be set up properly.
Somebody asks, can you give us a more formal definition of tactical versus strategic short? And I guess when when the moon is in the 7th house and the Jupiter aligns with Mars and all that other stuff, that's when something is strategic. No, I'm just kidding. Really what it is think of it in these terms. When I look at stocks that are short sale targets, there's two types. A lot of stocks you can come after off the peak, and so we know the way something might roll over right off the peak, but we also know that leading stock rolls off the peak and gets negative for a few days. It could just continue moving sideways, and so I'm just looking for a quick break. I mean, this strategically could have been short around 700, and then you could be covering down off the bounce at the top of the prior base, because I'm not expecting this to blow to pieces. It's not likely, but it does allow a short-term trade for points, as Livermore would say, and that I think of as being more tactical. It could evolve over time into something more strategic. Now let's take a look at Baidu, for example. And Baidu is set up in an ugly pattern. And if we look at a weekly chart down here, where's my weekly chart? Here we go. So looks like the pixie dust is running out again. You can see Baidu's been in the top for a period of time. So it's done that sort of ripening process where you've wrung all the bullish sentiment out of the stocks, and that bullish sentiment, when a leading stock pulls back for the first couple times, a lot of the people who miss the first move and are late come in buying, and they see it as a buying opportunity, and so you'll get these support and these buying rallies, or these rallies, short little rallies that give way, because you're basically in a process of distribution here. And that's basically what you're theorizing when you look at this pattern and elect to go short. You're saying you had a big run in the stock. It's had a huge move. This is a weekly chart, by the way. And you're breaking down, and it looks like you're possibly in position for a big move to the downside, because you've basically been pulling down on top of this formation here. That support has lasted for a while. Maybe it's giving way. If it does, then this could have a long move down, a la something like Netflix when it broke down here. And that becomes more strategic rather than tactical, and so time frames are probably a big part of what differs in. But it's just a different shade of how you would approach a short sale setup depending on the parameters of its technical layout, so to speak. So Apple right off the peak. It may be too early to short Apple, but it was possible to pick off, in fact, even a nice 10, maybe 13% move off that 700 level if you were campaigning it. And so, that's a tactical short. So that's really the difference. So GS on the upside, you'll notice I do have it on my screen here. I've been watching it. It is in this sort of cup with handle, and it's breaking out. So I'm still skeptical, though, of buying this sort of straight down, straight out to new highs pattern. Myself. What's your take there, Dr. K?
Yeah, those kind of straight up off the bottom patterns followed by a mini V, straight down, straight up. Very high risk to buy it at this level.
Yeah.
Probably it needs to consolidate a little longer, and then it becomes more viable.
Yeah, I don't really care for that, but it's acting pretty well today. So people ask Monster as a short. Well, we've looked at this one before. I think it's a short. You got this head and shoulders complex, getting more complex here. Another right shoulder. Here's a 50-day moving average. Try to get there. If you look at it on a weekly chart, you can see that you rallied right into the 10-week moving average, and you're rolling over here on a gap down move. So yeah, the way I would look at this one, I'm not short it myself. I'm busy with what I already have, and as I'm watching these things trade, they look like they're moving lower. Yep. You can see the gap up to the top of the range, so you could see that as a shortable gap type move, and so you could short it here using the high of yesterday at 55.05 as your upside stop, a quick upside. So you can also give it a couple of percent. but it looks pretty weak, and it is breaking down. But notice a couple things. The selling volume is not as heavy here, but that doesn't tell you anything per se. But it has come down a long way. I would prefer to catch something that's soon, early in its pattern. The monster was a breakdown here. I think we looked at this way back when, and so I tend to favor things like Priceline today, Baidu, Intuitive Surgical. They come out with earnings next week? Is that right, or is it today?
It says on here the 18th.
Yeah, okay, so not till next week. So it has plenty of time to go lower as far as I'm concerned. So does Baidu, which doesn't report until early November, and I think Priceline is the same situation. CMG is another one that we've talked about on the short side. I don't know if maybe it goes lower here. It was optimal to hit it when we were talking about it, and around this peak, around 340 as it rolled over. At this point, you're right under this level, so it almost seems like if you did want to short it, and you saw this as a short reverse or bear flag or a little ledge, then you could short it using the highs of these days as a quick stop, or the 10-day moving average, which you can see is quickly coming down to meet the stock, and below which the stock has remained all the way down since breaking down from the 340 level. So that's kind of one way to handle it, but not on my top list of shorts. Does Cisco look shortable to me? No, it's not a big former leader, but it looks like it's going lower. Yeah, so I guess you could short it. Lulu Pod, I was considering that yesterday, and it almost looks like it's failing here. So I'll tell you how I'd handle something like this. And this could be a pod, but it's not that deep of a cup formation, but it could also be a late-stage pattern. If we look at this on a long-term basis on the weekly chart, it's had a big run, and so this could fail. It could be a late-stage base, and a lot of times you will see these bigger, wider cup with handles fail, and so one way to handle this if you want to be shorted, but keep in mind a lot of other people are shorted as well, is to use a 10-day moving average of 74.52 as your upside stop. Notice how it could not get up there today, and it seems to be rolling over. That's a potential short sale trade, and tactically I would look for it to head for the 50-day if it breaks down. So it's probably going to need the market to help out, but that does look a little bit weak to me. Didn't really care much for the pattern before. It just seemed pretty deep, and this steep rise is not going to come out in a couple, 3 weeks and just break out right away to me. So it may very well just roll over. Let's see. Alexion, the biotechs have held up, but all you have here is stocks above its 50-day moving average, and that's about it. So if you've held the stock, you'd be waiting for either some sort of break, probably a violation of the 50-day, which would also take you below this breakout point. So Regeneron, here's another situation. We started buying this stock in here, and we got a nice 20-some% move, and I just unloaded the lots of it in this move, and it's come in. And maybe it needs to base, but it's holding above this breakout point here, this short little breakout point. And it doesn't tend to hold the 10-day moving average that well, so I'd be using the 50-day moving average as your ultimate selling guide. But, fair disclosure, we don't own the stock anymore. You can see a little more pixie dust. You see that happening here? Just a little bit more. In your experience, do you think it would be worth my time and money to broaden my trading skills by using options? Are you of the belief that I can be wildly successful as a trader without these skills? I think you can be fine with or without them. You may find options suit your taste better, and I know some guys whose trade our style, but primarily use options, and I think it just suits their psychology better, and they just have a better feel for it. But I think it's really a personal preference. I don't necessarily think that you have to have great option skills to be a successful investor. I certainly don't. I don't think Dr. K does either, right, Dr. K?
I've never used options. I've looked into them, and I just don't see the need. You also have a lot going against you in terms of time value and in terms of the spread. So if you're trading an account that's larger than, say, 50,000, you start moving the price around. And there's a lot of pitfalls with options, and so if you're going to do them, understand what you're up against, because the odds really favor the house, not the investor, when it comes to options.
Yeah, and you got to be pretty quick too. I can tell you, I remember on October 27th, 1997, when the Dow broke 500 points for the first time, I think in its history, on a point basis, the biggest downside point move. And I was 100% long put options in a number of stocks, and my account doubled overnight. And of course, that was a low, and the next day everything went back to where it was. So, you got to be quick on the draw there and have a system that allows you very quick trading access so you can move your positions quickly if you need to. And that was a very interesting case where I learned how options can mess with your mind. So, but they can be very effective tools on the other hand, because I remember buying 150 November 50 calls on C-Cube Microsystems in 1995 when the stock was trading at 37, and the November 50 calls, and that was in October, and November 50 calls were trading at $1.50. About 150 of them. Stock, by the time those options expired, was trading at 96. So 1.5 on each went to 46. Very nice move. So there's ways to use options to enhance your position, but I would think when you're trend trading for big moves in leading stocks, you're using the options just to load up on more stock and play the trend even in a more high-octane fashion, but with limited risk. So, because at $1.50, I thought those options were pretty cheap, and that was the first pullback to the 50-day moving average for C-Cube back in 1995 at the 37 level, roughly. So, F5 looks like a short. It's breaking down through the 50. Yeah, yesterday it broke through on heavy volume. Today we rallied up into the 50-day. Could have been shorted there. It looks like it's heading lower, probably to one of these lows. So, and there's a number of stocks looking that way. You can also see here's a head and shoulders on the weekly chart here. You got this. You actually got a couple of head and shoulders, and you'll see that happen sometimes. Stock form two head and shoulders side by side to make a big pod. See the big pod? And this thing blows apart. It could be headed lower, sure. In fact, I was looking at those as shorts, and I was playing these VMware as well for a couple days there on these breaks, but covered VMware yesterday, and of course it's going lower today. But same thing, you've got a complex head and shoulders formation here, and you're starting to break through this trend line here, but you're well above the neckline, and the neckline is I don't know. I'm gonna say it's like about here, so down closer to 80. So you might be headed for that neckline. That would be my first downside target. But it's almost the same exact thing as F5 in the sense that it's blowing through the 50-day moving average and kind of breaking down, and it's a very complex head and shoulders formation. So yeah, those look both weak. Somebody says they have 6 distribution days, Dr. K, and thought the market, the MDM would go to sell or neutral. Is that true? Are you counting the same way?
There are 5 distribution days. You cannot count the one on September 18th. That is not a distribution day.
Okay, and that's why.
Well, we had an email along a similar line, so I assume that's what the person means.
Right.
They thought, well, actually, at the time they thought there was 4 distribution days, and there were actually only 3 at that point because they were including September 18th.
Baidu's supposed to have earnings on 10/25, October 25th. Somebody asking is that Royal Gold? RGLD down 4.5%. Let's pull up the daily. Selling 5.25 million shares of common stock. Would you buy this pullback? Well, I didn't even buy the stock on the way up, so I'd be less inclined to buy this kind of pullback. It's got to settle down. They got to complete the offering, and then you see where it goes from there. Look at what happened to Coors. So somebody says, is there any way to get more real-time insight to trades you're looking at throughout the day? Well, yeah, if I wasn't trading all day. If I was somebody who just wanted to babble about the market all day, yeah, I could do that. But you got to remember, I'm a trader, and so is Dr. K. That's what we do primarily. And really, that's where we make our big money. And so to spend all day showing everybody my screen, and I'm doing this and I'm doing that, some days it's more coherent than others. I would say today, hitting some of these shorts, the reason I bring it up, and I thought it was appropriate to show what I'm doing today, is because today is a day where things are working. Interestingly enough, even with the market getting the pixie dust rally, and I think that's interesting, and I just kind of wanted to show how I'll work it. Now, I could get stopped out of these very quickly, but I'm certainly not going to be able to sit here all day or every day having an hour or sit here and not be paying attention to what I'm doing as a trader primarily. So it's a distraction. I mean, it'd be nice if we could, but almost there's kind of a paradox there because at what point do we cross over from just being babble mouths like Jim Cramer and guys who are actually trading? And I think I'd rather just be more a trader, and I think it works better for you guys. Dr. K, what news sources do you find useful for staying informed about European events? And can you talk about what's going on in Europe real quick? Because I'm going to take a quick bathroom break, and I'll be right
Sure.
back.
Well, in general, I'm using sources like Yahoo News, MarketWatch, Google News. These deliver timely news points throughout the day, and of course, I'm monitoring the situation over in Europe through by looking at what the exchanges in Europe are actually doing. In other words, before the U.S. market opens, you can take a look at how Europe's doing. You can the UK market, the German market, Paris, Italy, Spain, and so on. So I have a snapshot in real time of what those markets are doing, and that gives me a sense of where, or why U.S. futures might be trading higher or lower in the pre-market. And as far as the European news, I mean, it's all out there. I mean, the news is always out there, and I just want to keep abreast of any interesting turn of events that might push or lower the European bourses, and of course that in turn will have an effect on the U.S. market. But it's not rocket science, and it's all free. All this information is free, through MarketWatch, Google News, Yahoo News, and like Gil was saying, it doesn't make sense to pay for Bloomberg when you can get all this information at your fingertips for free. Because that's the age we're in. We're in such a great information age, and you just have to be smart about
definitely.
how you get it.
Definitely. Anyways, more questions. Is Disney just at the bottom of a channel, or is it rolling over? It's at the bottom of the Disney Channel, I guess. I don't know. Looks like it's trying to break the 50-day moving average here. So if you own the stock, it's held the 50-day pretty well. Actually, here you closed below back here in April. And we're looking at a daily chart, by the way. And it never violated the 50-day moving average. So I guess you would use the 50-day moving average as your selling guide. So if it closes below, like it did here, and it moves below the intraday low of this close below, assuming it does close below the 50-day, then that would be a sell signal. Each time the Fed has announced QE, the market has had a sizable move to the upside. This time with QE Unlimited, it seems that the market has changed character and sold off comment. That's precisely my observation as well, is that, and as I said, there are a couple of pixie dust refineries that have gone down recently, and so pixie dust supplies appear to be limited, so they're not able to manufacture a rally. But yeah, it is true that you had that announcement, and the market reacted for a short period of time, but really didn't set off a big rally. But you don't know whether that rally is yet to come or what's going on. I think you have to assume, I think, that as QE wears on, it loses its effectiveness, and I also think that if QE is the only driver for the market, and unless the economy can step up here and take up some of the slack, the demand, the collapse in demand, and take up some of the slack there that supposedly QE has been filling, although I'm not sure how that one works, the removal of QE could become a problem, and at some point, therefore, there becomes a phase of QE that becomes the final bid to sell into, unless there's another overwhelming or rather compelling driver for the market. So that's a possibility. But again, you can babble about what you think is going to happen and what might happen, and you just go with what you see and move with the market in real time, and that's really what we're trying to do here, and hopefully this webinar serves that purpose. Google is still holding. Google surprised me because it had a great move along the 10-day. But notice it did violate yesterday intraday, the 10-day. Now you've rallied up into it, so maybe it needs to go sideways. But it's been a strong stock, and here's a weekly chart. You notice it is coming out of a range that extends all the way back to the end of 2007. So it's right up at the peak now. So just about clearing to all-time highs, and acts okay. But it is starting to violate the 10-day. I don't own it, and I haven't, which shows you how smart I am. But I suppose that would be, I don't know, what would you use as your selling guide for Google, Dr. K?
Let's take a look. I mean, it continues to obey the 10 days, so I'd be using the 10-day. I mean, in other words, let's see, it's gone, several weeks. So yesterday would have been the sell. That would be a sell because it violates the 10-day as of October 10th. Yeah, I mean, and it's had a good move. It's had a really nice long move. I would be more than happy to take my profits yesterday and then wait to see what happens from here. If it's going to go higher, it's probably going to issue another pocket pivot after it has a chance to consolidate these gains.
Yeah, and as they say, bulls make money, bears make money, pigs get slaughtered. So I think that applies in this market environment more than any. Someone says, I assume when the general market is in a controlled correction, assuming a correction at any time is controlled and who is running those or working those controls. But anyways, I assume when the general market is in a controlled correction to a support area and you get a big update on volume and pocket pivots are plentiful, it is a very good time to get heavily invested with the pocket pivots. I'm trying to get it in my head that risk should be less at these moments when they happen. Am I correct? Well, I would say, I'll let Dr. K chime in after me, but I would say when you see that sort of thing happen and you have several buy points in stocks, leading stocks occurring all together, that's generally a good sign. I mean, there are other factors that are contextual. That might be the position of the market, whether you've been in a long-term bear market or where you are in a correction. But I think in general that is constructive, and it should be a low-risk entry point. Now, knowing that, it doesn't necessarily mean that it's going to be, and all you know is that if that should be a low-risk entry point based on the broad action in terms of a lot of pocket pivots and leading stocks as the market's turning, then you should be showing profits pretty quickly on those. And if you're not and you get stopped out very quickly, then obviously it wasn't so low risk, but it should give you some information a few days after you take entry points in certain leading stocks, or actually enter positions in certain leading stocks on that basis. And so you'll get feedback pretty quickly, and you just operate on that basis. But in general, I would say yes. Dr. K?
Yeah, if you get a confluence of quality pocket pivots, that's a very strong sign, regardless of the market direction model, that you should be buying. And a good example would be 1996. It was March of 1996. There were a number of names that had good, legitimate buy points, base breakout buy points. So I started buying, even though my model was on a neutral signal. And it wasn't until April that my model went to a buy signal, but I was already well invested by then. So you have to know when to override. I mean, the model is designed to keep you on the right side of the market, but that means that there will be exceptional times, like March of 1996, where you have to step in and start buying. Another example would be September of 2006, although the model was on a buy signal, so it was in concert with the market. But there were lots of pocket pivots in September of 2006, and in fact, there were more pocket pivots in that month than I had seen since March, April of 2003. So that was a clear indication that I should be buying heavily. I was fully margined, and that was the September, October, November period was the period I ran my account up about 115%, just force-feeding money into the best names, because there were lots of pocket pivots during those months. And that was the last time, by the way, that the market had a window of opportunity that was that long, a 3-month window. We laugh at that in the 1990s, a 3-month window, but in this decade, a 3-month, real bona fide 3-month window of opportunity seems like an eternity.
Yeah, definitely. Anyways, more questions before we wrap it up. It is 4 minutes after the hour, so we've gone about an hour so far. We did get a late start because I wanted to give more people time to get on the webinar this morning. LinkedIn obviously is going to come up. Yeah, you can see this one coming. Market gets weak. What it's going to do, it's going to pull back to the 50-day moving average. I'm going to confess to you that I bought some yesterday at the close and got a nice gap this morning and bumped it out and sold it. And it's a little bit risky, but I believe in the QE fairy. Do you? And she came and made me happy this morning on the LinkedIn, and I sold it. And now I think it's heading through its 50-day moving average because it should be holding up better than this. But again, this sort of points out why I think in this environment especially, quiet pocket pivots are useful. And remember, we were buying the pocket pivots along the 50-day line down here back in August. And so you get this move, to 125, and so you're getting that 15-20% move. And we were pretty heavy, as I recall, and I just felt, that sort of percentage move in this environment, statistically it seems to show that stocks do that, and then that's it. And so, sell into that. Now here we come back into the 50-day moving average. I've been looking for that, and it's hard to tell whether this is ready to go, but I would look for some sort of pocket pivot on this. But if you violate the 50-day, that's got to be your last line in the sand in terms of dumping the stock. Now, Coors, you'll notice it's up on my screen here, and I have to tell you that on a tactical basis, I have considered the stock to be shortable here along the 10-day moving average. And I do a lot of work on the short side, and a lot of it, there's experimental stuff, and there's just stuff, I get ideas in my head, and I'm not as good as Dr. K at doing the statistical work, and sometimes that's how we work well together, so I'll come up with some weird concept, and he'll test it, refine it, and make it better. But, what I see here is a little mini head and shoulders, sort of a pinhead move here. And this almost looks manipulated, because you have this huge volume and you've got 23 million shares dumped in the market. So my theory is that short-term Coors is saturated, and institutional demand was sucked up on that secondary offering, and they increased the float, I think, by about 20% or more, and that's a pretty good increase in the float. So my theory is that it's going to test the 50-day moving average. The only problem is it's only to 51.26, but I'm also looking at the possibility that this could turn into an IPO-based failure, and a lot of times you have an IPO come out. If you look at this base, really, it is kind of loose, and looking at it with a critical eye, it does look kind of loose. You have this big move straight up off the lows. It's holding in tight on a weekly basis, so to me, is a potential for a failure, and I actually have been hitting this rally here, and it moves to the bottom of the range, and you cover it, and now we're doing this here, and I'm actually putting it out up here. It's pushing against me maybe 15, 20 cents right now, but I'm just kind of hanging with it and kind of pinging it to see if it rolls over. Volume's picking up a little bit so far today. It's above the 10-day moving average, but tactically I'm almost looking for it to fail here and roll through the 50-day moving average, and it may not work. So, that said, on the weekly chart it is holding up relatively tight. So far you would say that's constructive, but within the context of its daily action, it looks a little bit saturated to me in that it could pull back and test this low again, and that might not be abnormal, particularly if the market correction continues. So that's my view on Coors. Dr. K, you have anything to add on that, or did I cover it all?
You pretty much covered it. The base wasn't as it's not a very attractive looking basing pattern on the daily or the weekly, but the thing is it did have a gap up, which is very strong, so that compensated for the defective pattern.
Yeah, and the other thing is also, you try to get into labeling bases, you're better off just going with the Bible gap up, because all you know for sure is you have a Bible gap up, you use the low, this gap up day right here on August 14th, and you're using a stop at the intraday low there with maybe a couple of percent to allow for porosity. If you trade it on that basis, then you're fine. And so it was viable on that basis, but it may not have a sustained move from here because maybe the original base wasn't so hot. I mean, we'll find out. And I'm going to tell you that this is a little experimental, but, full disclosure, I am pinging it on the short side, so everybody go ahead and run it in for me and put me out of my misery. How's that? CRM is a short, possibly another pod, but right now it's a little bit jagged. I'd be looking for some sort of violation of the 50-day at this point. But it's looking pod-like, and if the group, and I would say if you go back and look at the big stock cloud stocks like F5 and VMware and Salesforce.com, they were kind of the first ones before it became a hot topic in 2010. They might be in position to roll over, so keep an eye on those. If we see them as setting up, we'll probably put out short sale setup reports, but I should emphasize that with the market down 4 days off the peak and coming down where it is right now, we're trying to pick the very best short sale ideas we can talk about, and I also do try to keep one or two exclusive to you guys who are on the webinars. So we're trying to be very careful here in terms of what we put out on the short side, and I notice there are a lot of stocks looking weak and moving lower, and so we know in hindsight that some of these are pretty bad and they could be shorted or have been shorted over the last few days. But you're trying to pick the very best ones. I like Baidu as a short here. I think Priceline also as a short, and Intuitive Surgical probably going into next week's earnings. Maybe it continues to move lower, and might even toy with the possibility of holding a small 10 or 20% position short going into earnings on Intuitive Surgical, because the pattern does not look very good to me. And it is a big, widely owned leader. So Update on TVIX. No, I'm not talking about October 1987. I'm talking about October 1997. So you can go back and look at the market charts on October 27, 1997. The market broke very hard. F5 below, 5 below. We talked about that one. That's not one that 5 below. It's not something that we're interested in at all. DaVita is just continuing to move higher. Here's the daily chart. So there's nothing really there to say. On the other hand, keep in mind what I've been talking about. When you have profits in stocks, it doesn't hurt to take some profits. Let's see, I've already answered some of these.
Someone wanted to know our take on CRM. I just got an email.
Right, I just discussed that, Dr. K.
Right, I know. I don't know why this email just came in now. I mean, we've gone over.
I mean, we talked about it, and as I said, maybe it is a pod, and on the basis of what F5 and VMware are doing, maybe there's some validity to that. But we'd be watching this. If you did want to short it, you think it's imminently going to break the 50-day, similar to what I'm trying to do with cores, but you can see it's still pushing against me, just a pinch. Maybe that's going to happen. So, but you can watch it happening, and maybe the fact that F5 and VMware are breaking down, that tells you this is next. But you can also wait for a violation of the 50-day moving average to short it and go after it there. But if you want to be an early bird, I guess you could go after it here on the premise that this will work on the downside because F5 and VMware are breaking as well. Affymax is kind of in climax mode here. Nice little blip there. That seems somewhat climactic to me. So if I owned it, I'd be selling it. Somebody else, I would like to start a managed account. You have to talk to Ross Haber. Just email us at info@mochainvestors.com. I think that's what it is, or is it VMAP? V-M-A-P. V as in Victor, M as in Mary, A, P as in Peter. At mochainvestors.com, and that's M-O-K-A investors.com. You take the first two letters of both my last name and Dr. K's last name, put them together, you get Mocha, and that's the name of that firm. Anyways, I think we've pretty much covered it. There's a lot more questions. I guess we'd go on forever, but NSM, I'm going to cover the last two. NSM, like I've been saying, this thing's had a big run, so it's got a base, and so I'd be inclined to be taking profits in here and kind of hanging out, waiting for the next buy point. Cerner is a stock that we talked about as a short, but it stopped out real quick in here. But you notice how it has moved higher, and so it's formed a left shoulder, head, and a right shoulder. Now you're starting to break down, but you're a few days off the peak, and it would be logical for a bounce off of here. I'd watch it bounce up into 75, 76 to short into, actually, and I don't think I'd want to own the stock. I would be selling it definitely if I owned it. I would be selling it definitely on a violation of the 50-day moving average if you want to give it more time, or if you got to bounce off the 50-day moving average. So TCBI, last one we're going to do. It's still holding the 10-day moving average, so really can't tell you anything there other than that. So you got anything magic there, Dr. K?
Nope. Use the looks okay to me. Just use the 7-week rule as your sell guide.
Yeah, and so so that's basically it, you guys. We see some short sale ideas. We gave you a couple yesterday. They're working today. At least Baidu seems to be rolling down. And just keep in mind that the QE fairy is still out there, and you never know when she's going to show up. Although it could be a he as well, as I pointed out earlier, depending on particular lifestyle. Anyways, so that's it, you guys. Any other questions, you can email us at info@virtueofselfishinvesting.com, and we'll catch you next time. So we know what we're looking for. Just stick to your stops. Got some short sale ideas. Maybe they work, maybe they don't. Maybe we're in a broader top, maybe we're not. I think you need more evidence before that becomes conclusive. But things are looking a little dicey right now in terms of the number of leaders you're seeing kind of give it up, and that might be your first indication. But on the other hand, the QE fairy is still out there, and she can show up at any time. So that's all we got. You guys take care, and thanks for showing up, as always. We'll catch you next time.
So long, everyone.